Okay, let's unpack this. Welcome to the deep dive, your shortcut to being truly well-informed. We take your sources, dig deep, and pull out the most important nuggets of knowledge and insight. This week, you've handed us an incredibly timely macro analysis, specifically zeroing in on the Forex market for July 7th to 13th, 2025. Wow, it's packed with economic forecasts, market sentiment, strategic insights, lots to get through.
Yeah, what really stands out immediately in these sources is the core tension defining the week. It's a classic showdown, really, between tangible geopolitical risk, that looming U.S. tariff deadline, and then a whole slew of major central bank decisions that are, overwhelmingly trending towards easing monetary policy. Our mission today is basically to decode how this dynamic could play out, how it impacts everything from global risk sentiment to major currency movements, and most importantly, what it all means for you.
Exactly. So how do we make sense of this complex interplay without getting completely lost in the weeds? We're going to highlight the absolute top events, explain the underlying forces driving them, and walk you through the potential ripple effects across the market. Sound good? Let's jump in.
Sounds great. So the overarching theme for the week really is this tug of war. On one side, you've got the very real, very scheduled geopolitical risk of the U.S. tariff deadline. That's July 9th. On the other side, you have major central banks like the Reserve Bank of Australia, the RBNZ in New Zealand, the Bank of Korea. They're all signaling they're ready to cut interest rates, mostly because of these ongoing trade uncertainties.
And here's where it gets really interesting, I think. The market isn't just watching the tariffs themselves, right? But how that event impacts global risk sentiment. Like, will a negative tariff outcome push central banks to ease even more aggressively? And crucially, those Federal Open Market Committee meeting minutes, they'll offer essential clues about whether the U.S. Fed is more worried about tariff-induced inflation or a slowdown in growth. That distinction seems absolutely key for the U.S. dollar's direction, don't you think?
Absolutely. It's the Fed's reaction function. We're trying to, read the tea leaves on there. How will they react?
Okay, we've got a fantastic dashboard here ranking the top 10 events by potential market impact. Think of this as your priority list for the week, the key drivers you really need to get a handle on. Let's dive into the biggest one first. First up, the U.S. tariff deadline on July 9th. Yeah, this is the big one. The 90-day pause on retaliatory tariffs, they range from 11% to 50%. Well, that ends. Our source outlines three main scenarios: reimposition, new trade deals, or an extension for more talks. An extension is seen as the most likely, but, and this is important, President Trump has explicitly confirmed letters are being prepared for potential tariff hikes, from 10% up to a whopping 70%.
Yeah, 70%.
Yeah.
That's significant. And this deadline isn't just about trade figures. It has huge implications. Global supply chains, inflation forecasts, overall economic growth. If tariffs are reimposed, you could very quickly see price changes on everyday goods, maybe noticeable slowdown in economic activity. What's fascinating here is how our different models analyze this. Take our interest rate differential shock model, the IRDS. It suggests that full tariff reimposition would severely hit global growth. That puts immense pressure on the Fed to cut rates. Now, initially, that might cause the U.S. dollar to weaken, you'd think. But the immediate shock, the crisis feel, could quickly reverse that into a flight to safety, strengthening the dollar.
Okay, so a bit counterintuitive maybe. Weakness then, strength.
Could be. Depends on the shock factor versus the rate cut expectation. Now, an extension, that's the base case, right? That probably keeps Fed cut expectations stable. But a negative surprise, like actual reimposition, that significantly increases the odds of a September Fed cut, pushing the yield curve more dovish, more focused on supporting growth.
Got it. And what about sentiment? How does that model see it?
Right, our risk-on, risk-off sentiment index, or RO. This event is pure risk-off. It scores a very high -85, strong fear. So a negative outcome triggers that classic flight to safety. Investors rushing for secure assets. The VIX, the fear gauge, currently pretty low, like 16, 17. It could easily jump past that high-risk 2025 level. We'd also see the economic policy uncertainty index, already high, spike even higher. All points to strong demand for safe havens, gold, yen, maybe even the dollar, despite the rate pressure.
Okay, so high fear potential. What about volatility itself? Is the market expecting big moves?
Well, that's the interesting part. Our volatility breakout probability model shows current implied volatility is surprisingly low. Yet everyone knows this is a potential volatility event. The model indicates the ratio of 1 week implied vol to 1 month historical vol for pairs like LUSD, USD, JPY. It could surge above 1.5.
1.5. So what does that mean practically?
It suggests the market is pricing in the potential for a strong, almost binary move. Like either things are okay or they're really not okay. A sharp move either way.
Right. And how are traders positioned going into this?
That's where our order flow imbalance model is revealing. CFTC data shows speculators are actually net short the US dollar, about 6,000 contracts short, and they're heavily net long risk currencies, like the euro over 111,000 net long contracts.
Whoa, wait. Short USD and long euro before a major potential risk-off event, that sounds.
Exactly. It means traders are offside. They've made big bets in one direction, but the big risk points the other way. A tariff shock could force these positions to close violently. That creates the potential for a massive short squeeze for the US dollar. Everyone who sold it suddenly has to buy it back, pushing the price up sharply.
A short squeeze, okay, and the surprise factor.
Our macro surprise impact model confirms the market consensus leans heavily towards an extension. That's what's expected. So, the biggest surprise, the real shock, would be immediate reimposition of high tariffs. The pip beta, how much a currency pair moves on a surprise, would be huge. We could see major pairs move 150, maybe 200 pips within hours.
Wow. Okay, that paints a really vivid picture. So what you're saying is the market expects things to be okay, an expansion maybe, but the risks are heavily skewed to a really nasty surprise. And this combination, traders betting the wrong way for that kind of shock, it creates potential for an explosive US dollar rally.
That's the risk scenario, yes. Those traders who sold the dollar expecting Fed cuts might be forced to buy it back if tariffs hit hard. That amplifies the rise. And those currencies most sensitive to global sentiment, Aussie dollar, Kiwi dollar, Canadian dollar, emerging market currencies, they'd likely suffer the most in that scenario.
Okay, so how might someone think about positioning for this? What are the strategies?
Well, for a more proactive approach, maybe buying out-of-the-money call options on USDJPY or put options on AUD-USD. They offer those asymmetrical returns if the risk-off shock really hits hard. Low cost, potentially high payoff.
Right, options for defined risk. What about direct trades?
If tariffs are reimposed, a more direct approach might be selling IUDSD, maybe targeting below 0.6400, and buying USDJPY, perhaps aiming for a break towards 147.00. Buying gold, XAUSD, is also a top pick in that scenario. It's the classic safe haven. Could break $3,330, maybe head towards $3,430.
And if we just get the mild scenario, the expected extension,
Then you might see a short-lived relief rally. Stocks up, risk currencies up a bit. But I wouldn't expect it to last long. It's largely priced in. Could easily become a sell-the-fact situation after a brief pop.
sell fact. Okay, makes sense. All right, let's shift gears from trade to monetary policy. The FOMC meeting minutes on July 10th. These are the details from the June 17-18 Fed meeting, where they held rates steady at 4.50%. The market's going to be coming through every word, right? Looking for clues on that big dilemma, tariff inflation versus tariff growth slowdown.
Exactly. This context is critical, especially coming just hours after that initial tariff deadline impact, whatever it might be. This report is really about revealing the Fed's reaction function, how they'll likely respond going forward. Are they more worried about prices going up or growth slowing down? Their leanings here directly influence future rate decisions, which, impacts your borrowing costs, the wider economy. Our RDS model shows the market's pricing about a 75% chance of a September rate cut right now.
75%.
Pretty
Right.
It is. And the specific tone of these minutes will shift those odds. A hawkish tone, more worry about inflation, would likely push back those cut expectations. That supports the dollar. A dovish tone, more worry about growth, brings those cut expectations forward, maybe even hints at July. That would pressure the dollar.
Okay. And how does this play out in terms of risk sentiment?
On our RO index, a hawkish surprise from the minutes would likely be risk-off for stocks, but bullish for the US dollar. That's a classic divergence you sometimes see. A dovish tone, though. Risk-on for stocks, bearish for the dollar. And remember, the Citi Economic Surprise Index for the U.S. is negative right now, so any hawkish surprise from the Fed's assessment would hit harder, be more unexpected.
And the positioning aspect again, short USD, long EUR.
Still relevant here, too. Our OFI model flags that. If the minutes are surprisingly hawkish, it creates significant pain trade risk. Could trigger a sharp drop in USD as those big long positions unwind fast.
So the surprise factor is key.
Definitely. For our MSI model, the surprise lies in the language nuances. The market expects balance, data dependency. Any strong lean, either way prioritizing inflation or growth, would be a big surprise. And a hawkish surprise, maybe mentioning inflation risks from tariffs specifically, probably has a higher pip beta for the dollar, just given how skewed the market is towards expecting dovishness.
So basically, these minutes clarify the Fed's hierarchy of fears. Fear inflation more, dollar wins. Fear unemployment or slowdown more, dollar likely loses. That gives us a clear framework, especially with tariffs complicating things. What kind of market moves should people watch for?
Okay, if the minutes sound hawkish, suggesting inflation is the bigger worry, you could look to sell USD if it breaks below, say, 1.1700. Target may be 1.1570. Could also consider buying the DXY, the dollar index. If these sound dovish, more focused on growth risks, then maybe buy USD if it holds above 1.180, targeting 1.190Y, and potentially sell USD JPY. For those wanting to play the volatility itself before the event, maybe look at straddle or strangle option strategies on USD. They profit from a big move up or down.
Got it. Okay, let's move across the Pacific. China CPI and PPI data on July 9th. This is for June. Forecasts look pretty weak. Consumer inflation near zero, 0.0% year-on-year CPI, and significant producer deflation, minus 3.2% year-on-year PPI. This seems like a crucial gauge of China's domestic demand and maybe its potential to export deflation globally.
Absolutely. China's economic health casts a long shadow, affects global trade, commodity prices, everything. If China's seeing deflation, yeah, it might mean cheaper goods for you eventually, but it also signals a fundamental slowdown in a massive global engine. From our IRDS perspective, persistent weak inflation makes it much more likely the People's Bank of China, the PBOC, will ease policy further, rate cuts, reserve requirement cuts.
Yeah.
That would widen the negative interest rate gap versus the US dollar, pressuring the Chinese yuan, the CNH, and also currencies closely tied to it, like the Aussie and Kiwi dollars.
Okay, so bad for AUD and NZD. How does it register on the risk scale?
Our RO index flags weaker than expected data here as moderately risk off. Scores minus 60. It confirms those worries about China slowing down, hits global growth sentiment, and weighs on commodity currencies.
And the surprise potential, given forecasts are already low.
Right, for MSI, a true surprise would be CPI actually turning negative, say minus 0.2%, or PPI falling much deeper, maybe minus 4.0%. The Australian dollar's pip beta is really sensitive to bad news out of China.
You know, I think that PPI number is arguably even more crucial here, wouldn't you agree?
I would, yeah.
Deep negative PPI suggests Chinese factories are just slashing prices, excess capacity, weak demand, and those cheaper goods get exported, right? Pushing down inflation in the US, in Europe.
Which gives the Fed and the ECB more room to be dovish.
Exactly. So very weak China PPI isn't just bearish for the AUD, it's indirectly bearish for global bond yields too, and fundamentally bad for commodity currencies generally.
Well put. So strategy-wise, if PPI comes in weaker than minus 3.5%, it would reinforce reasons to be short AUD-USD, target maybe 0.6350, especially if the RBA has already cut rates by then. If CPI itself turns negative, that's a major headline risk. Amplifies any risk-off moves, hits the AUD even harder. On the flip side, if Chinese data surprises positively, say, PPI improves towards minus 2.5%, you might see a short-term relief bounce in AUSD. But like we said, the broader trend is still challenged by RBA dovishness, tariff risks. So any pop could be a chance to sell into strength.
Okay, makes sense. Let's shift focus to North America now. The Canada Employment Report on July 11th, June's labor force survey. Forecasts look pretty modest, maybe at a 10K job gain, unemployment holding high at 7.0%. We know the labor market there has weakened, unemployment's up 2 percentage points in 2 years. And manufacturing feels the pressure from U.S. trade uncertainty. Seems key for the Bank of Canada.
Yeah, Canada's job market health is a really direct barometer for a major U.S. trading partner. Gives you insights into how trade tensions are hitting real economies. That manufacturing sector detail is telling. Significant weakness there would strongly suggest tariffs are really biting. So if the numbers match or are weaker than forecasts, that could strengthen the U.S. dollar against the Canadian dollar, USD CAD. A break above recent resistance opens the door higher. But if we get a surprise upside, strong job growth, say over 40K, then you'd expect the Canadian dollar to strengthen. Look to sell USD CAD, maybe aiming for lower support levels.
Any cross trades involving CAD?
Potentially. If Canada data is weak, but global risk sentiment is okay, maybe selling CDDGP could be attractive. Combines CAD weakness with the yen's safe haven potential.
Interesting. Okay, speaking of central banks, let's tune down under Australia. The RBA rate decision on July 8th, widely expected this one. Lots of analysts forecasting a 25 basis point cut to 3.60%, driven by weaker growth, lowish inflation CPI at 2.1%, near the bottom of their target band, and global trade worries looming large, of course.
Right. And rate cuts directly impact borrowing costs,
Exactly.
the full economic outlook for Australia, a key global commodity producer. The most likely scenario is that 25 basis point cut. The market's partly priced it in. So the initial reaction might actually be a slight AUD rally. Traders covering shorts, maybe. But the underlying reality, lower rates, weak outlook, China risks, tariff risks, could make that bounce a really good selling opportunity. Classic sell fact play, potentially.
Ah, the old sell the fact. So in that scenario, how should people think about positioning? And what if the RBA surprises?
Okay, base case. 25 BP is cut. Maybe wait for that initial pop after the announcement. Then look to open short AUSD positions as momentum fades, perhaps near technical resistance. If they surprise hawkishly no cut, then expect an immediate, strong buy signal for AUPC. Could jump over 100 pips as the market totally reprices the RPA path. On the other hand, if they cut and strongly signal more easing is coming, that's a clear sell signal for AUSD. Confirms a deeper easing cycle, prolonged downward pressure.
Clear scenarios there. Okay, let's pop over to the UK. UK monthly GDP data on July 11th, this is from May, follows that concerning 0.3% drop in April, remember, after decent Q1. Another weak number would really raise fears of stagnation, trade uncertainty, higher wage costs. It's all weighing. Though recent PMI data hinted at a rebound from April's low, consensus is just plus 0.1%.
Yeah, the UK economy's health impacts global growth sentiment, offers clues on how developed economies are navigating things. It feels like a critical juncture, really. Is April's drop an anomaly or the start of a trend? June PMI did show some service sector recovery, but the overall picture feels fragile. If this GDP number comes in below zero, 2 straight months of decline, that significantly boosts the odds of the Bank of England turning more dovish. Potential sell signal for GBP USD. But if GDP surprises strongly, say above 0.3%, that strong rebound eases recession fears, could definitely strengthen the pound.
All right, let's check in on New Zealand. RBNZ rate decision on July 9th. They already cut 25 basis points back in May, down to 3.25%. Now, they're expected to hold rates in July, but the consensus is they'll sound very dovish. Short-term inflation is okay, but weaker growth and global tariff risks are big concerns. Another rate cut soon seems possible.
Yes, similar to the RBA, this decision matters for borrowing costs and signals the health of another export-led economy facing global headwinds. The RBNZ will likely play it cautiously, hold rates, but issue an extremely dovish statement. Basically leave the door wide open for an August or September cut, lets them buy time, assess the tariff fallout. For traders, it means the Kiwi dollar might not drop immediately on the decision, but its upside is likely capped.
So, the strategy there.
Base case is that dovish hold. Look for chances to sell NZD USD at resistance levels after the meeting. Upside momentum will be limited if they do surprise with a cut. Then sell NZD USD straddling. Clear signal of deep RBNZ concern.
Okay. Now, something a bit different but simmering in the background. The BRICS plus summit fallout. That's likely to echo through the week. The summit in Brazil just wrapped up, welcomed new members, focused on alternative financial planning, non-SWIFT payments, local currency trade. Common currency is still way off, but the de-dollarization narrative itself feels significant psychologically, doesn't it?
It does. It signals a long-term shift in global economic power dynamics. Now, it's not an immediate market mover like a tariff deadline, definitely not this week, but it's a structural trend. Could really influence the dollar's global role over time. This week, mostly psychological impact. Headlines about major nations trying to reduce USD reliance. It subtly erodes confidence in the greenback, especially with U.S. debt issues, erratic trade policy. It creates a kind of structural headwind for the dollar and actually a tailwind for gold.
Interesting. So how might someone trade on that longer-term narrative?
Well, maybe use any dollar rallies caused by other factors, strong U.S. data, say as opportunities to open longer-term short positions on the USD. The thesis being this BRICS plus narrative caps its upside over time, and buying gold, XAU USD. Gold's a direct beneficiary of de-dollarization talk. Any concrete announcements from the summit, even post-summit, would just reinforce buying gold as an alternative reserve asset.
Right. Gold is the anti-dollar in some ways. Okay, back to Asia one more time. Bokke rate decision in South Korea July 10th. Bank of Korea cut to 2.50% in May. Q1 slowdown, U.S. tariff threats. Same story, really. With trade uncertainty ongoing, another rate cut is definitely seen as on the table. Seems like a key gauge for risk appetite in Asia.
Absolutely. South Korea, another major export economy, its central bank's actions combined with the RBA and RBNZ. It provides a collective signal on how the Asia-Pacific is coping. A series of cuts from these banks, Bokke and RBNZ, would send a strong, clear message. Growth is decelerating the region. That's negative for AUD, NZD, and the Korean one, KRW.
So if the Bokke does cut,
selling signal for regional risk assets. Maybe sell Asian stock indices or regional currencies against safe havens like JPY or USD, if they hold. Might offer temporary support for KRW regional sentiment, but the overall trend still feels challenging.
Okay, nearly there. Last big event, energy. OPEC World Oil Outlook on July 10th. This is their 19th annual long-term view on oil supply and demand. It'll get compared to the more pessimistic views out there, like from the IEA or JP Morgan forecasting Brent down at $66 in 2025. OPEC's assumptions influence long-term prices, investment, and commodity currencies like CAD.
Yeah, oil prices hit everything. Gas-pumped manufacturing costs, affects daily expenses, broader stability. OPEC's long-term view can set trends. The oil market's caught between these conflicting stories right now. OPEC usually puts out more optimistic demand forecasts, help support prices. Others, like IEA banks, are more pessimistic. The WO, the World Oil Outlook, is OPEC's latest shot in this narrative war.
So how might this impact currencies?
While impact on CAD is the most direct. If the WO is strongly bullish, reinforces oil prices, that supports the Canadian dollar. Might consider selling USD CAD if oil breaks key resistance. Also, higher long-term oil price outlook feeds into global inflation expectations. That could actually support gold, XA USD as an inflation hedge. It's all interconnected.
Wow, okay. So summing all that up, this week really does feel like a perilous balancing act. Main driver, the big unknown, is that binary risk from the U.S. tariff deadline.
Exactly. That geopolitical shockwave, however it lands, will be absorbed and refracted by all these dovish central banks around the world. A negative tariff outcome wouldn't just trigger a classic risk-off move, it would also validate and probably accelerate those dovish shifts from the RBA, RBNZ, Book and A, creating potential for really amplified one-sided moves in AUD, NZD, KRW. And the FOMC minutes are absolutely key. They could either break that loop for the US dollar or reinforce it.
Okay. Based on all that, our most compelling market idea for the week seems to be selling IODSD. It feels like it captures the convergence of the strongest themes, doesn't it? Why is it so compelling right now?
Well, first, the RBA looks poised to cut rates. Direct negative for the Aussie dollar. Second, AUD's fate is so closely tied to China, where we're expecting potentially deflationary data. And third, the AUD is just a classic high-beta risk-off currency, meaning it's super sensitive to global economic mood swings, makes it extremely vulnerable to a negative surprise from that U.S. tariff deadline.
So the strategy there.
For those considering it, maybe look to open short positions if prices break recent support levels, or add to existing shorts, probably best after the RBA decision is known. Target below 0.6400 perhaps. And if that China PPI reading comes in weaker than expected, that would be a strong confirming signal for this outlook.
But high potential usually means high risk. Always important to remember. What should our listeners be watching out for, risk-wise?
Yeah, absolutely crucial. The primary risk, the big game changer, would be an unexpected comprehensive trade deal struck before the deadline. That just flips the script completely. It invalidates the main risk-off thesis, triggers a fierce relief rally in risk assets, could cause a nasty whipsaw effect, catching people off guard.
Ouch. Okay, any other big risks?
Secondary risk,
Yeah.
surprisingly and strongly dovish FOMC minutes, like hinting a July Fed cut is suddenly back on the table, that could override any safe haven buying for the dollar as the market pivots purely to Fed easing expectations.
Got it. And what about volatility? You mentioned it was low.
Yeah, a low VIX around 16, 17 signals complacency maybe. It's like a coiled spring. Our volatility breakout probability model suggests a high chance of a breakout. So expect vol to be relatively low, maybe Monday, Tuesday, then potentially explode from Wednesday onwards as these events hit. Oh, and one last critical detail from that positioning data. Knowing the market's heavily net short USD and net long UR before a major risk event like the tariff deadline, that's a significant warning. Risk of a painful reversal is high, especially with those extreme positions. Euro longs over 111K, yen shorts over 147K. It's very stretched.
Good flag. Okay, finally, a quick note for listeners interested in the Vietnamese dong, the VND. No major local data or central bank meetings scheduled this week in Vietnam. However, the VND stability will be indirectly tested by two main external factors. First, the direction of the U.S. dollar after the FOMC minutes and the tariff event, a stronger USD broadly pressures VND. Second, that Chinese inflation data is key. A significant slowdown in China could spill over into Vietnam's trade outlook, even with Vietnam's own strong Q2 GDP growth, which was 7.96%. So definitely monitor the USD-VND pair for any signs of pressure if these external risks flare up. Phew. Okay, what stands out to you from this whole deep dive? It really feels like more than just numbers this week. It's like a high-stakes chess match. Geopolitics versus central bank responses.
It really is. And if you connect it to the bigger picture, it raises a fascinating question, I think. In this incredibly interconnected global economy, how much can individual nations really insulate themselves from these huge trade and monetary policy decisions made by the economic giants?
That's a really interesting thought to mull over. Underscores just how linked everything is now. We certainly hope this deep dive has given you, our listener, a clearer picture of the complex forces at play in the global markets this week, and maybe how they might impact you. Until next time, keep exploring, keep learning, and keep getting informed the deep dive way.